Here to talk about that is 13 ABC financial analyst, financial expert Alan Lancz. Good to see you. Have the Lancz letter. Alan,
Thank you.
As always, good to have you on the
pleasure.
program. A good time, for I thought, for you to come on after what had been a series of record-breaking weeks for the Dow Jones Industrials. And then 2013, really an outstanding year, too. So, but this after a bumpy week this past week. So just reflect on 2013 and where we might be headed this year.
Yeah, it was interestingly, everything went up, in 2013, and much more so than anybody expected. I think even November, December were record months, and a lot of investors were getting out of bonds where they're showing losses for the first time just to go into stocks.
First time in decades, you say?
Exactly, 15 years, and really it was 94 before they had significant losses like they had last year in bonds. Commodities did poorly if you were investing in gold. So really didn't give investors a lot of choices, and that's why I think a lot of money flooded into stocks. Unfortunately, those year-end gains maybe discounted some of the future gains for 2014, and that's why you've got a little abrupt market so far in 2014.
Yeah, I mean, but 2014 started out, we almost saw it, 2013 ends, couple of record highs early, and then all of a sudden things trend down here. What about looking ahead, looking your crystal ball, if you will, and go back up again?
Yeah, it will go back up. I think, you never know what will derail a market. And, who would expect it was Russia and Turkey and Argentina currencies that would really derail, and the worries about emerging markets that really this week created losses not seen for a year and a half. But I think long term, this will be a buying opportunity. But you have to be in the right areas. That's what we talked about in our year-end report. And it means...
The right areas, Alan. So that means what?
Well, I would avoid still long-term bonds, treasuries. They were down 8% last year. So you're getting, like on a 10-year, 2.7% yield. And you got a chance of losing more than that. So the risk-reward is skewed. I would start getting into areas where they're selling, but I wouldn't chase those companies that have done so well. I think there's just too much risk. And it's interestingly that in 2014...
Companies like whom?
Well, like a Tesla, Best Buy, Super Value, those stocks tripled, quadrupled, and there's just too much risk.
Got to come back to earth? Is that what you're saying?
Exactly, exactly, yeah.
Okay, so looking ahead, and if there are stocks to look at, and you say you want to always, obviously you want to buy low, watch them ascend. Some have gotten to the apex, you believe. So, here we are. Everything's not free, but this is free TV for the most part. What are the general areas, Alan, that you could advise people to look at?
I would buy companies that are still at historic lows, pay good dividends, like telecom and utilities last year did very poorly. Underperformed. Look at those areas because you're going to get a good dividend. We think you're going to be lucky to get high single digits in 2014. So if you can get a 5% dividend yield right away, you're halfway to that return of 2014, and you're taking a lot less risk, which is our most important theme for 2014.
As we get older, we tend to be less risky, I think, right?
Well, you're supposed to be, but sometimes you get that high market and people get that greed factor, and they think it's going to continue going up, and I think that's what you got to avoid.
Well, that's emotion, isn't it?
Exactly. That's what I was just going to say. You got to avoid putting emotion into your investment decisions. That's the most important thing.
Let's talk local companies born and bred here in Northwest Ohio, that some of which have gone gangbusters the last couple of years. People think about the Andersons in the store, but it's the rail cars and it's the other avenues in which they
commodities.
Commodities. What about the Andersons as an investment going forward in 2014?
Well, I think Andersons is a well-managed company, and I think the Toledo companies are really managed probably as well as I've seen in the 30 years I've been in the business. Now, some of those companies, their stocks have gone up quite a bit. So again,
from the brink of nothing. If you talk about Owens Corning and bankruptcy and the asbestos situation.
Exactly. So use any kind of weakness to buy. Don't again chase. It is interesting you ask about local because we did recommend Healthcare REIT, a local company with a 5% dividend for 2014. The stock was in the 80s. It's down to 52, 53. So that's when you want to buy, after the sell-off, not chasing it, in the 80s. So.
Our neighbors across the street here.
Exactly.
Healthcare REIT. I mentioned Owens Corning, Owens, Illinois, and the big three. Although Chrysler's it's not a public situation. quite yet. Is that correct?
Right.
But GM and Ford. What about getting into the big ones as far as automotive is concerned?
Again, I wouldn't chase them. No? You know, when GM came out public the second time here after the financial crisis, you know, we said to avoid it. It came out at 38, went down to 19. We thought it was a great buy then. Now it's back in the 38, 40 area. I think it's fairly valued. That's you know, a situation. They're making great progress. Yeah. Companies are doing well. No. GM, new leadership. Ford, great leadership. So I think those are great companies. But again, I wouldn't chase them here.
Huh. Okay. And lastly, I thought about First Solar, headquartered out in Arizona, but such a big stake here in Northwest Ohio. Many people work for that company. First Solar and that whole industry.
Yeah, really volatile. I mean, much different than the companies we talked about prior. You know, I think they have a niche, and they're a leader in the industry, which we really like as far as in investing. But again, most of our clients are more preservation of capital oriented, and it might be a little bit too, as far as speculative for our blood. Factors that we probably should look at in 2014 that could really swing the market either way. We talked about the State of the Union with Jacqueline Policastro, what President Obama is looking at going forward, what will be the big issues. We have the Sochi Olympics, the terror threat, a lot of factors going forward this year. Could all of those work to derail an economic recovery? Oh yeah, definitely. I think, you know, no progress as far
healthcare.
As government-wise, the healthcare. I mean, there's so many headwinds that the market was looking at. You know, 2013 was so good. We know that 2014 will be good. And whenever you get that, our contrarian radar goes up because we think, you know, there's going to be something to, you know, as far as get this market off track. I don't know what else it'll be, but there's enough headwinds out there geopolitically, economically with the emerging markets. And, you know, as far as even in the U.S., I think our growth, I mean, we're seeing a recovery, but it's anemic. So it's going to be a situation where a lot of the gains last year were multiple expansion, meaning they're anticipating good growth and good sales in 2014. If we don't see that, if it's only anemic growth, then we, you know, that could pressure the market too. So all in all, I think it's a time to be careful, but there will be bargains. I think in the long term, any kind of selling, use that to your advantage.
All right, and finally, the metrics you look at as the economic indicators: housing starts, unemployment, car sales. What else?
I'd look at the 10-year. I mean, that's really important. 10-year Treasuries. You know, when bonds were hurting, they spiked up to over 3%, and now they're back down because of the worries on the emerging markets. What we need is a gradually increasing interest rate environment where we're tapering or weaning off these subsidies as far as artificially depressing interest rates. So if we can handle that, that's going to be a big positive. If we're not, then it's going to be more of the same where it's artificial gains instead of fundamentally driven gains through a stronger economy.
Okay, we just don't want to go back to 08, 09.
Exactly.
Right? Even if it's slow growth, keep on growing, right?
Yeah, and I think, you know, back then it was a systemic problem. Now this is more just correction. So I wouldn't, back then we were, you know, as far as taking profits in 2007 and looking to buy into big weakness, I don't think you're going to see as much a weakness, Lee. So I think take advantage of, you know, if this sell-off continues the next few weeks, buy quality companies and hold them for the long term. Okay, good stuff. We hope we didn't get too much inside baseball there on the with Alan Lancz of the Lancz Letter. Thanks very much for talking the economy, stocks, bonds, what have you. Thanks, My pleasure.
Alan. Okay, we're going to come back in just